In 48 hours, silver lost $13, 89 to 76, a 14.5% collapse, one of the most violent single drops of the entire year. And if you're watching financial news right now, you're seeing the same headlines everywhere. Silver crashes, bull market over, investors flee precious metals. And retail traders, people who bought silver 3 weeks ago because they finally believed the thesis, are panic selling at the bottom, handing their positions back to the exact institutions that sold to them in the first place. I want you to stop. Because what just happened in silver is not what the headlines are telling you. This was not a market collapse. This was an operation. A carefully engineered, historically documented, repeatedly executed institutional playbook designed to do one thing: shake retail out of silver before the next leg up. And in the next 10 minutes, I'm going to prove it to you. Not with opinion, with mechanism, with history. With the exact 4-step sequence the banks used this week to take silver from 89 down to 76 in 48 hours. And once you understand how this works, you will never panic sell a manufactured crash again. This is Recession Warnings. Let's get into it. Before I show you the 4 forces behind this crash, I need you to understand what was actually happening on the way up. Because the move to 89 was not speculation. It was not retail hype. It was not a meme trade. The move to 89 was driven by structural physical demand. 6 consecutive years of industrial silver deficit, the Bank of America real assets chart hitting 100-year extremes, a $17 trillion global liquidity injection over 24 months, and forced short covering from bullion banks whose short positions were becoming mathematically dangerous. Every single piece of that move was legitimate institutional flow, real money, real demand, real pressure on a real physical market that has been in structural deficit for years. When silver ran from the low 60s to 89, it was not a bubble. It was physics, supply constrained, demand expanding, price had no choice but to rise. And then silver got within $1 of 90, and everything changed. Here is why 90 matters more than any other number in this story. 90 was not just a round number. 90 was the single most heavily anticipated technical resistance level of the entire silver rally. Every chartist on the planet had it marked. Every institutional algorithm had it programmed. Every options desk on Wall Street had massive positions structured around silver staying below 90. When price approached that level, it did not just create selling pressure, it created systemic pressure. Because above 90, the next major target was 100. Above 100, the previous all-time high sat at 121. And above 121, the math for the bullion bank's short book turned catastrophic. So they did what they always do. They crashed it. Now let me show you exactly how. There were 4 forces. 3 of them are mechanical. 1 of them is the actual weapon. And they did not operate randomly. They operated in sequence, each one amplifying the next, until what started as normal profit-taking became a panic-inducing 14% collapse in less than 2 days. The first force is the simplest and the most misunderstood. When any asset approaches a major psychological resistance level, $90, $50, $100, smart money does not buy more to push through it. Smart money sells. Large institutional players who had been long silver since the 60s and 70s took profits just below 90. Their exit alone was not enough to crash silver, but their exits triggered every algorithm watching the same level. Each algorithmic sell order triggered the next. Each price tick lower brought more automated selling. And within the first few hours of silver failing at 89, it had already fallen to 84, $5 an hour. And I want to be clear, this part was not manipulation. This part was positioning. This is normal market behavior at major resistance. Institutions take profits, algorithms follow, retail gets caught buying at the top. This happens in every market, in every cycle, at every major level. What made this week different was what came next. The second force was macro cover. The US dollar had been weakening for weeks leading into silver's run to 89. A weak dollar is rocket fuel for dollar-denominated commodities like silver and gold. It was a core part of why silver moved so aggressively. But this week, the dollar bounced. Treasury yields moved higher. Federal Reserve communication turned slightly more hawkish on the rate path. And then April inflation data printed at 3.8%, the hottest reading since May of 2023. In a matter of days, the macro picture shifted from tailwind to headwind. Silver trades inversely to the dollar. When the dollar strengthens, silver faces automatic mechanical selling pressure from institutional desks that model commodity prices against currency moves. None of this changed the structural thesis. The Fed is still trapped. Real rates are still negative when you measure against actual inflation. The physical deficit is still running. But a short-term dollar bounce gave institutional desks the macro narrative they needed to start unwinding silver positions without looking manipulative. Silver fell from 84 to 80 in this phase. Two forces down, both real, both mechanical, neither one manufactured. What came next was different. The third force is where the operation begins. The largest bullion banks in the world don't just trade silver, they vault it. They hold massive physical silver inventories to satisfy contractual obligations, allocated accounts, ETF backing, industrial supply agreements. And those vaults had been running dangerously low after years of structural demand outpacing supply. At $89 per ounce, restocking those vaults was prohibitively expensive. At $76, it becomes substantially cheaper. $13 per ounce cheaper across millions of ounces of required inventory is not a rounding error. That is hundreds of millions of dollars in acquisition cost savings. The banks needed a price reset to restock physical inventories at manageable cost. And to get that price reset, they needed retail to panic sell and hand them the physical supply. So they manufactured the conditions for panic. Stop-loss orders, automatic sell orders that retail traders place below key support levels to limit losses, were sitting in clusters below 80, below 78, below 76. Each cluster was a loaded trap. The banks didn't need to push silver down with massive naked short selling. They just needed to push it below the first cluster. The stop losses did the rest. 80 breaks. Automated selling fires. Price drops to 78. The 78 cluster fires. Price drops to 76. The 76 cluster fires. And in hours, silver is down another $4 with the banks having done very little of the actual selling themselves. Retail stopped themselves out, handed physical supply to the institutions at a $13 discount, and never saw it coming. But even all three of those forces combined, profit-taking at resistance, macro dollar bounce, stop-loss hunting, would not have produced the kind of violent crash silver experienced this week without the fourth force, the actual weapon. The one Wall Street reaches for every single time silver threatens to break a critical level. The Chicago Mercantile Exchange, the CME, controls the margin requirements for silver futures contracts. If you are not familiar with how futures margins work, here is the short version. To hold a silver futures contract, you must post a specific amount of cash as collateral, called margin. That margin requirement is set by the CME. In normal markets, margin requirements are stable. They move slowly. They reflect the typical volatility of the underlying asset. But the CME has the discretionary power to raise margin requirements at any time and by any amount. And historically, every single time silver has approached a major psychological breakout level, the CME has executed the same playbook. They raise margins, suddenly and sharply. When margin requirements go up by 30 or 40% overnight, every trader holding silver futures faces an immediate choice. Post additional cash within hours, or get liquidated. Smaller traders, the ones without immediate access to large cash reserves, cannot meet the call. Their positions are automatically closed at whatever price the market is at that moment. That forced selling drops the price. The price drop creates new margin calls on other traders. Those traders also get liquidated. The cascade begins. What started as an exchange operational decision becomes a domino chain of forced selling that has nothing to do with physical silver, industrial demand, or any fundamental reality. It is paper market mechanics weaponized against retail. This is Recession Warnings, and we are just getting started on why this changes everything about the setup going forward. Stay with me. The historical record on CME margin hikes in silver is not subtle. It is one of the most clearly documented institutional patterns in modern commodity markets. In January of 2026, silver crashed 33%, from $121 to $74 in a matter of days. The primary catalyst was a CME margin hike that triggered cascading forced liquidations across the entire silver futures complex. The crash looked catastrophic. It felt like the bull market was finished, and within 4 months, silver returned to 89. In 2011, silver was approaching $50 for the first time since the Hunt brothers era. The CME raised margin requirements 5 times in 9 days, a cumulative increase of over 80%. Silver collapsed from $49 to $34 within weeks. Every analyst called the bull market dead. Silver eventually reached $121 in 2026. And in 1980, when the Hunt brothers had accumulated such a massive silver position that the exchange itself was threatened, the CME and COMEX changed the rules mid-game, limiting new purchases to liquidation orders only, specifically to break their corner. Silver collapsed, and eventually, 4 decades later, the structural forces the Hunts had identified proved correct anyway. The mechanism delays the move. It has never once prevented it. Every margin hike in silver history has been followed by silver eventually exceeding the level it was crashed away from. Every single one. The banks buy the dip they engineer, and retail sells it to them. Here's the part of this story that almost nobody covering the silver crash this week is telling you, and it is the most important part. When you layer the four forces together, technical resistance profit taking, macro dollar cover, stop loss hunting, CME margin hike cascade, what you actually get is not evidence that the silver bull market is broken. You get a blueprint. A documented, repeatable, historically verified blueprint of exactly what happens when silver gets close enough to a breakout that the institution's short paper silver can no longer ignore the threat. And here is what that blueprint tells you about right now. The structural drivers behind silver's move to 89 have not weakened. They have intensified. The Bank of America real assets versus financial assets ratio is still at 100-year extremes. Global money supply still expanded $17 trillion in 24 months. The industrial silver deficit is still running in its sixth consecutive year. Shanghai physical premiums are still at multi-decade highs, signaling that Asian physical demand is not slowing, it is accelerating. COMEX registered silver inventories are still depleted relative to open interest, meaning the paper-to-physical leverage ratio is still dangerously extended. None of those forces were changed by a margin hike. None of those forces were changed by a dollar bounce. None of those forces were changed by algorithmic stop-loss hunting. The physical silver market does not care about CME margin requirements. It cares about supply and demand. And supply and demand still overwhelmingly favor higher prices. The crash did not change the thesis. The crash was the thesis confirming itself. Because the only reason to engineer a margin hike at 89 is if 89 was about to become 90, and 90 was about to become a problem. Now I want to talk about what is actually happening with the money right now. Because this is where most retail investors get the story completely backwards. When silver dropped from 89 to 76 this week, two things happened simultaneously. Retail panic sold, and institutions bought. Not in small quantities, in size. The same banks that engineered the stop-loss cascade, the same desks that needed cheaper silver to restock their physical vaults, the same players who benefit from lower acquisition costs, they were on the other side of every panic sell order retail placed this week. This is not speculation. This is documented behavioral pattern across every prior CME margin hike cycle in silver's history. After the January 2026 crash from 121 to 74, COMEX warehouse data showed a significant increase in registered silver inventories in the weeks following the crash, precisely as retail liquidation handed physical supply to institutional vaults at distressed prices. After the 2011 crash from 49 to 34, the same pattern repeated. Institutions accumulated at the lows. Retail sold at the lows. And when silver eventually resumed its structural move higher, the institutions held the metal, and the retail traders who sold were left watching from the sidelines. If you sold silver this week, you did not escape a bear market. You transferred your silver to a bank at a $13 discount, paid for by your own panic. That is the operation. That is how it works every single time. So what do you watch now? Because thesis intact is not the same as trade confirmed. You need signals. Specific, observable, data-driven signals that tell you whether silver is consolidating before the next leg up, or whether the macro pressure has become sustained enough to delay the move further. Here are the 5 signals I am tracking in real time. First, silver's weekly close. A close back above $80 per ounce is the minimum confirmation that the consolidation is short-term and the breakout structure is intact. Below 80, silver is still in correction mode. A weekly close below 74 would be a warning signal that macro headwinds are stronger and more sustained than the structural thesis currently suggests, and would require reassessment. Second, the US dollar index. The macro cover for this crash was a dollar bounce. If the DXY reverses lower from current levels, and there are strong structural reasons to believe the dollar strength is a short-term technical bounce rather than a trend reversal, the macro headwind unwinds rapidly, and silver gets an immediate tailwind. Watch DXY closely. Its direction over the next 2 to 3 weeks will tell you more about silver's next move than almost any other single data point. Third, COMEX silver open interest. Margin hike forced liquidations typically reset open interest to multi-year lows as over-leveraged positions are forcibly closed. When open interest compresses to those levels, the market is technically clean, the weak hands are out, the leverage is reset, and the next sustained move higher has no overhead liquidation risk to fight through. If open interest stays compressed in coming weeks, the setup for the next acceleration phase is mathematically cleaner than it was at 89. Fourth, junior gold miners through GDXJ. Mining stocks are the smart money's early positioning indicator. If GDXJ holds above its breakout trend line despite the paper market chaos in silver, it tells you institutional positioning in the broader precious metals trade is unchanged. If mining stocks break down alongside metals, that would indicate the structural rotation has been delayed, not destroyed, but delayed. Fifth, the gold to silver ratio. This ratio measures silver's performance relative to gold. When silver outperforms, the ratio falls. When gold leads, the ratio rises. A move back below 55 on the ratio confirms silver outperformance is resuming, and the next leg of the silver trade is activating. A sustained move above 60 would indicate gold is regaining institutional leadership, and silver's relative move may need another consolidation phase before it runs again. Track all five together. No single signal is definitive. The convergence of signals is what tells you the story. Let me show you exactly what a confirmation sequence looks like, because this matters for how you position over the coming weeks. The highest probability scenario, based on the historical pattern following every prior CME margin hike, is a consolidation phase lasting 2 to 6 weeks, during which silver trades in a range roughly between 74 and 82, while institutions complete their physical restocking and the paper market flushes remaining weak hands. Following that consolidation, the next attempted run at 90 begins. And because the forced liquidation reset open interest and the vault restocking reduced institutional urgency to suppress price, the next run at 90 carries better odds of cracking it than the one that just failed. Because here is the pattern that defines every single one of these margin hike events in silver history. The mechanism is designed to delay, not destroy. It works by resetting the conditions. But the structural forces that drove the move in the first place do not reset. They accumulate. The physical deficit does not pause during a margin hike. Industrial demand does not pause during a paper market cascade. Monetary debasement does not pause because the CME changed its collateral requirements. Every week that the structural drivers continue while the paper market suppresses price is another week of coiled spring energy loading into the next move. When that spring releases, and based on every historical precedent in silver's modern history, it always has, the move is larger than the one that was delayed. Not smaller, larger. The banks buy time. They do not buy permanence. Now I want to address directly the people watching this who sold this week, because I know some of you did. And I know that some of you are sitting in a difficult position right now, watching silver trade at 76, knowing you sold in the high 70s or low 80s, wondering whether to buy back in or wait. First, no judgment. The crash was engineered to feel like a fundamental breakdown. It was designed to shake you out. The institutions that built this playbook have been running it for decades, and they are very good at making manufactured crashes feel like genuine collapses. The panic you felt was rational given the information you had in the moment. What matters now is what you do with the information you have after seeing the full picture. The thesis has not changed. The structural drivers have not changed. What changed is the price at which you can now re-enter a structurally bullish silver market, $13 lower than it was 48 hours ago. Whether that opportunity is one you act on depends on your own situation, your own time horizon, your own risk tolerance. I am not your financial advisor. I am showing you the mechanism. What you do with it is your decision. What I can tell you is what the historically documented pattern says happened this week. The banks needed cheaper silver. They needed retail panic to generate the selling flow that would let them accumulate at a discount. They engineered the conditions for that panic using a documented, repeatable, four-step playbook. They got what they needed. And now, with physical inventories restocked at a discount and open interest reset to cleaner levels, the structural forces that drove silver from the 60s to 89 are still fully intact, pointed in the same direction, with the paper market overhang reduced. That is not a bear market setup. That is a reload. The same institutions that crashed silver this week are now positioned long at the lows they manufactured. And when silver retests 90, not if, when, they will be the ones profiting from the move they delayed and then front-ran on the way back up. That is how the game works. The only question is whether you understand it well enough to stay on the right side of it. Every time they run this playbook, they transfer wealth from retail investors who panic to institutional players who understand the mechanism. That transfer happened this week. Whether you are on the giving side or the receiving side is something only you know. But now you understand how it works. And the next time they run it, and there will be a next time, you will recognize it in real time, instead of 6 weeks after the fact when silver is back at 90 and the panic feels embarrassing in hindsight. The silver thesis is intact. The structural setup is stronger now than it was at 89, because at 89 the easy money had already been made. At 76, you are buying at the exact price the banks manufactured to accumulate for themselves. They crashed it to buy it. They are buying it right now. The only thing standing between you and the same position they just built is whether you understand what actually happened this week, or whether you believe the headlines. This is Recession Warnings. Drop your position in the comments below, accumulating here, holding through, or sitting in cash waiting for confirmation. I read every single one, and I will be back when the next signal fires. Hit like on your way out. It takes 1 second, and it pushes this analysis to the investors who need to see it most.